Ah, the stock market. Where else can you theoretically make money when things go down? It's like betting against your favorite sports team, except instead of just losing your shirt, you could lose your house, your car, and maybe even your neighbor's cat. I'm talking, of course, about short selling. It's a practice as old as the market itself, shrouded in jargon and whispered about in hushed tones. Some say it's a necessary evil, others a recipe for disaster. Tonight, we're diving headfirst into the world of short selling, exploring its intricacies, its risks, and of course, the inevitable shenanigans it attracts. Buckle up, because things are about to get financially complicated. Short selling starts with a simple yet slightly audacious move, borrowing something that isn't yours. In this case, it's stocks. Next, you sell those borrowed stocks at the current market price, hoping they'll plummet faster than a lead balloon full of bad decisions. If all goes according to plan, you buy back the stocks at a lower price, pocket the difference, and return them to the lender. Easy peasy, right? The borrowed stocks are returned to the lender, ideally leaving you with a tidy profit. But as with all things in life, there are a few catches. This is where the rubber meets the road, folks. Did your bet pay off, or are you left holding the bag and a hefty bill? While it might sound like gambling with a fancy name, short selling can be a legitimate investment strategy. Think of it as an insurance policy for your portfolio, protecting you from the inevitable market hiccups. Short sellers can act as a sort of market vigilante, exposing overvalued companies and keeping everyone honest. Remember that whole unlimited loss potential thing? Yeah, we weren't kidding. Short selling requires playing with borrowed money, and let me tell you, brokers don't like to be kept waiting. A short squeeze occurs when a heavily shorted stock's price rises rapidly, forcing short sellers to buy back shares at higher prices to cover their positions, further driving up the price. Short selling exists in a legal grey area, with regulators constantly playing catch-up to prevent market manipulation. The cost of borrowing shares can be high, especially for stocks that are in high demand for shorting. Like any powerful tool, short selling can be used for good or evil, and sometimes things get downright nasty. Calls for greater transparency in short selling are growing louder, aiming to level the playing field for all investors. Short selling can either be a boon or a bane to market liquidity, depending on how it's used. Short selling has played a pivotal role in some of the most dramatic financial events in recent history. Well, as with most things in the financial world, it's complicated. Short selling can be a valuable tool for exposing fraud and managing risk, but it also carries the potential for abuse and market instability. It's a bit like fire, incredibly useful when controlled, but capable of causing immense damage if left unchecked. Ultimately, understanding short selling is crucial for anyone looking to navigate the treacherous, often absurd waters of the stock market. If you're ready to get started with a leading broker, please check the details provided in the description. Don't forget to like and subscribe to our channel for your daily dose of inspiration and exciting updates.